What if I told you that the biggest move in gold and silver is not behind us, but still ahead? What if the recent drop in prices was not a warning sign, but actually the final opportunity before a massive breakout? Right now, most people are confused. They see gold pulling back, silver correcting, and they start to panic. But smart money doesn't panic. Smart money prepares. Because in markets like this, the biggest wealth is not made during the hype. It's made right after the shakeout. Welcome to Gold Silver Scope, where we break down gold and silver in the simplest way so you can understand what's really happening behind the scenes. Let's start with the most important thing, the recent price action. Gold and silver both saw a strong rally earlier, reaching levels that got everyone excited. Gold pushed above extremely high levels, and silver followed with explosive momentum. But then suddenly, prices dropped. And this is where most people get it wrong. They think the trend is over. They think the bull run is finished. But in reality, what we just saw was something very normal in a strong market. A healthy correction. This kind of sell-off is actually a good sign. Why? Because during the big rally, a lot of short-term traders and speculators jumped into the market. These are not long-term investors. They are people looking for quick profits. The moment prices stop going up, they panic and sell. And that selling creates pressure on the market. So what happens next? The market clears them out. It removes this weak money from the system. And that's exactly what we've just witnessed. Now the market is cleaner, stronger, more stable. The people who are left are the ones who understand the long-term picture. And this is why the next move is usually even stronger than the previous one. Think of it like a train. When it's overloaded with unnecessary weight, it slows down. But once that weight is removed, it moves faster and more powerfully. Right now, gold is holding strong even after the pullback, and silver, even more interesting, has established a new support level. Earlier, certain price zones acted as resistance, meaning prices struggled to go above them. But once those levels were broken, they became support. This is a classic bullish signal. It tells us that the market is building a strong base for the next move higher. Many people are waiting for prices to go back to old lower levels. But that's not how strong bull markets work. When a market breaks out of a major resistance, it rarely goes back to those old levels. Instead, it builds new support at higher prices and then continues upward. And that is exactly what we are seeing now. Another important thing to understand is psychology. Markets are driven by emotions, fear, and greed. When prices were going up TZC, everyone wanted to buy. But now that prices have dropped slightly, those same people are afraid. This is the biggest mistake retail investors make. They buy high because of excitement, and they sell low because of fear. But professional investors do the opposite. They wait for corrections. They wait for fear, because that's when opportunities appear. And right now, we are in that exact phase. A moment where the market is quietly preparing for its next big move, while most people are still unsure. Also, don't forget one key principle. Trends don't change overnight. A strong uptrend does not suddenly become a downtrend because of one correction. It takes time, multiple signals, and major structural changes for a trend to reverse. And right now, none of those signs are clearly visible. Instead, what we see is consolidation, a pause before continuation. So if you are looking at gold and silver right now and feeling confused, just remember this. The market is not ending. It is resetting. And resets in bull markets are not weaknesses. They are opportunities. Now let's go deeper into the real reason why gold and silver are not just moving randomly, but are actually being pushed higher by powerful forces that most people don't fully understand. The biggest driver right now is the economy. And not the version you see in headlines, but the real economy that people experience in their daily lives. there is a growing gap between what is being said and what is actually happening. On the surface, everything may look stable or even strong, but underneath, there are clear signs of weakness. People are feeling the pressure, costs are rising, purchasing power is falling, and confidence is slowly breaking down. This is where gold and silver come into play. When trust in the economy starts to weaken, investors naturally move toward assets that hold value over time. Gold has always been seen as a store of value, and silver follows closely because of both its monetary and industrial demand. So when uncertainty increases, demand for these metals quietly builds in the background. One of the biggest threats right now is something called stagflation, a situation where the economy slows down, but prices keep rising. This is one of the most dangerous economic environments because it puts pressure on both consumers and policymakers at the same time. People earn less or struggle to grow their income, but their expenses keep increasing. That creates stress across the entire system. And here's the key point. Stagflation is extremely bullish for gold and silver. Why? Because in this situation, central banks are trapped. If they try to fight inflation by raising interest rates, they risk damaging the economy even more. But if they try to support the economy by lowering rates, they risk making inflation worse. Either way, the system becomes unstable. Right now, central banks are trying to hold their position. They are waiting, watching, and hoping things improve. But history shows us that they cannot stay neutral for long. Eventually, pressure builds, from the economy, from the markets, and from political forces. And when that pressure becomes too strong, they are forced to act. Most likely, that action will be in the form of rate cuts and stimulus. And this is where things get very interesting. Whenever central banks start cutting rates or printing money to support the economy, it weakens the currency. And when the currency weakens, gold and silver become more valuable. This is not just theory. This is something we have seen again and again throughout history. Another important concept to understand is real interest rates. This is the difference between interest rates and inflation. Even if central banks keep rates high, if inflation is rising faster, then real interest rates are actually going down. And falling real interest rates are one of the strongest bullish signals for gold. Right now, that's exactly what is happening. Inflation is not truly under control, even if official numbers try to suggest otherwise. In reality, the cost of living continues to rise. Everyday expenses, food, energy, basic services, are becoming more expensive. People feel it, even if it's not fully reflected in official data. And when real interest rates fall, holding cash becomes less attractive. People start looking for alternatives. They want assets that can protect their purchasing power. That's when gold and silver start to shine. There is also another misunderstanding in the market right now. Many investors believe that gold only performs well when interest rates are falling. But recent trends have already proven that this is not always true. Gold has shown strength even in periods where rates were rising. This tells us something very important. The underlying demand for gold is stronger than most people think. It's no longer just about interest rates, it's about confidence in the entire financial system. And that confidence is slowly eroding. At the same time, the stock market is sending mixed signals. Sometimes it rallies strongly, attracting investors toward riskier assets. When that happens, gold may temporarily lose attention. But these phases don't last forever. As soon as uncertainty returns, money flows back into safe haven assets. What we are seeing right now is a transition phase. The market is moving between risk-on and risk-off behavior. Traders are reacting to short-term news, but long-term investors are quietly positioning themselves for what's coming next. And what's coming next is likely to be much bigger than what we've already seen. Also, don't forget how markets react to news. Often prices move based on expectations, not actual events. For example, if investors expect a crisis, they may buy gold before it happens. And when the event actually occurs, prices may temporarily drop because the expectation has already been priced in. This is known as buy the rumor, sell the fact. We've already seen signs of this behavior, but the important thing is the bigger trend. And that trend is still pointing upward. So when you combine all these factors, economic weakness, rising inflation, falling real interest rates, and growing uncertainty, the direction becomes clear. Gold and silver are not just moving randomly. They are responding to a much larger shift in the global financial system. And we are still in the early stages of that shift. Now let's talk about one of the most misunderstood topics in the entire financial world: inflation. Almost everyone talks about it, but very few people truly understand what it is and what actually causes it. And this misunderstanding is exactly why most investors get gold and silver wrong. Most people think inflation simply means prices going up. When they see fuel getting expensive, food prices rising, or daily expenses increasing, they say inflation is high. But this is only the surface. Rising prices are the result, not the real cause. The real cause of inflation is the expansion of money supply. In simple terms, when more money is created in the system without an equal increase in goods and services, the value of money goes down. And when the value of money falls, everything priced in that currency becomes more expensive. That's when you see prices rising across the board, not just in one or two areas, but everywhere. Now here's where things get interesting. A lot of people believe that higher oil prices are what cause inflation. But that's not entirely true. Yes, oil prices can push certain costs higher, especially transportation and energy. But oil alone does not create inflation across the entire economy. In fact, higher oil prices can actually slow down the economy. Think about it like this. If people are forced to spend more money on fuel, electricity, and basic needs, they have less money left for other things. They start cutting back on unnecessary expenses. They delay buying new gadgets, avoid vacations, and reduce spending on luxury items. This reduces demand in other parts of the economy. So instead of creating inflation everywhere, higher oil prices can shift spending, increasing prices in one area while reducing demand in another. True inflation happens when the system itself is flooded with money. And this is where central banks come in. Whenever the economy shows signs of weakness, central banks often respond by injecting more money into the system. They lower interest rates, encourage borrowing, and sometimes directly increase the money supply. This is done to stimulate growth, but it comes with a cost. That cost is inflation. Because when more money enters the system, it doesn't stay in one place. It spreads across all sectors, pushing up the prices of goods, services, assets, and even investments. This is why, during periods of aggressive monetary policies, we often see everything getting more expensive at the same time. And right now, we are heading toward that kind of environment again. Even if central banks are currently holding back, the pressure is building. Economic weakness, rising unemployment risks, and market instability are all pushing them toward taking action. And when they do act, it is very likely that they will once again increase liquidity in the system. That means more money, chasing the same amount of goods. And that is the perfect setup for higher inflation. Now let's connect this back to gold and silver. Gold and silver are not just commodities. They are monetary assets. They have been used as money for thousands of years because they cannot be printed or created out of thin air. Their supply is limited, and that gives them value. So when the value of paper currency starts to fall due to inflation, gold and silver naturally rise in value. It's not that gold is becoming more valuable on its own. It's that the currency used to measure it is losing value. This is a very important shift in perspective. When you see gold going up, don't just think gold is rising. Think currency is weakening, because that's the real story behind the movement. Another key point is how inflation is reported. Official data often shows lower inflation numbers than what people actually experience. But real life tells a different story. When you look at everyday expenses, groceries, utilities, transportation, the increase feels much higher than what is officially reported. This gap between official data and real experience creates confusion in the market. Some investors rely on official numbers and assume inflation is under control. Others look at real-world costs and see that inflation is still a serious problem. And this difference in perception creates opportunities, especially for those who understand what's really happening. Even small examples can reveal the truth. When basic services or everyday items increase steadily over time, it shows that the purchasing power of money is declining. And this decline is not temporary. It builds slowly, year after year, until it becomes impossible to ignore. This is exactly the kind of environment where gold and silver perform best, because they are not dependent on central bank policies. They are not tied to government decisions. They exist outside the system, acting as a form of protection against the very policies that create inflation in the first place. So, when you combine everything, money printing, economic pressure, rising costs, and declining purchasing power, the direction becomes clear once again. Gold and silver are not reacting randomly. They are responding to a deeper shift in the value of money itself. And this shift is far from over. Now let's talk about something that confuses almost every investor at some point. Why gold and silver sometimes move in ways that don't make sense. Why do they fall during bad news? Why do they rise when things seem calm? And why does the market often react in the exact opposite way people expect? To understand this, you need to understand how markets actually work. Markets are not driven by logic alone. They are driven by expectations, emotions, and positioning. What matters is not just what happens, but what people think is going to happen next. For example, most people believe that during war, crisis, or global tension, gold should go up because it is a safe haven. And yes, in the long term, that is true. But in the short term, things can look very different. Sometimes gold rises before the crisis even begins. Investors anticipate the problem, they buy early, and prices move up in advance. Then when the event actually happens, instead of going higher, gold may fall. Why? Because the expectation has already been priced in. Traders take profits. This is what we call buy the rumor, sell the fact. And this is exactly the kind of behavior we've been seeing. Another layer to this is competition between assets. Gold does not exist in isolation. It competes with stocks, crypto, and other investments for attention and capital. When the stock market is performing strongly, many investors move their money into riskier assets because they are chasing higher returns. This reduces demand for gold in the short term. So even if global conditions are uncertain, if stocks are rising aggressively, gold might temporarily lose momentum. But here's the key. These are short-term shifts, not long-term changes. The long-term direction of gold and silver is driven by much bigger forces like inflation, currency weakness, and economic instability. Short-term movements are just noise within that bigger trend. Another important factor is how the market interprets central bank actions. Right now, many investors believe that gold will only rise if interest rates are cut. So whenever there is news that suggests rates might stay high, gold may fall. And when there is news suggesting rate cuts, gold may rise. But this thinking is incomplete, because the real driver is not just interest rates, it's real interest rates. If inflation is rising faster than interest rates, then real returns are actually negative. And negative real returns are very bullish for gold. So even if central banks keep rates high, if inflation keeps climbing, gold can still move higher. This is something the market is slowly starting to understand, but not everyone has fully adjusted yet. That's why we see these confusing reactions, where gold moves opposite to expectations in the short term. There's also a psychological factor at play. Investors often behave like a crowd. When prices are rising, they feel confident and rush in. When prices fall, they feel fear and rush out. This creates cycles of overbuying and overselling, and smart investors use these cycles to their advantage. Right now, after the recent correction, many people are still uncertain. They are waiting for confirmation. They want to feel safe before entering again. But by the time everything feels safe, prices are usually much higher. That's how markets work. Opportunity rarely feels comfortable. Another interesting point is how quickly sentiment can change. One day the market is optimistic, the next day it's fearful. News headlines shift, narratives change, and investors react instantly. But beneath all this noise, the core fundamentals remain the same. And those fundamentals are still pointing in one direction: upward pressure on gold and silver. Also, don't forget the role of liquidity. When there is a lot of money flowing in the system, it eventually finds its way into assets. Sometimes it goes into stocks, sometimes into real estate, sometimes into crypto, and eventually it flows into gold and silver. This movement doesn't happen all at once. It rotates from one asset to another. We are currently in a phase where this rotation is happening. Money is moving, adjusting, repositioning. And once it settles, the next strong move begins. So when you see gold reacting in unexpected ways, don't assume something is wrong. Instead, understand that the market is adjusting to new information, new expectations, and new positioning. The bigger picture has not changed. In fact, it's becoming stronger. And this is exactly why experienced investors stay focused on the long-term trend instead of getting distracted by short-term noise. Because in the end, it's not the daily movement that builds wealth. It's the major trend. Now let's bring everything together. We've looked at the price action, the economic reality, inflation, and market psychology. And when you connect all these dots, one clear picture starts to form. Gold and silver are not just in a random cycle. They are in a powerful long-term uptrend that is still far from its peak. What we recently experienced was not the end of the move. It was a reset. The market removed weak hands, reduced speculation, and built a stronger foundation. And now, the stage is being set for the next leg higher. This is how every major bull market works. It doesn't go straight up. It moves in waves: rally, correction, consolidation, and then expansion. Right now, we are moving from consolidation toward expansion. The economic environment is adding fuel to this trend. Growth is slowing down, but inflation is not going away. This creates pressure on central banks. Sooner or later, they will be forced to support the system. And that usually means more liquidity, more money creation, and weaker currencies. And when currencies weaken, gold and silver don't just rise, they accelerate. At the same time, real interest rates are quietly moving lower. Even if official rates stay high, they are not keeping up with the real cost of living. This means holding cash is becoming less attractive, and investors will continue searching for assets that can protect their wealth. That's where gold and silver stand out. They are not promises. They are not dependent on policies. They are real, tangible assets that have held value across generations. And in times like these, that stability becomes extremely important. Another key point is positioning. Right now, many people are still on the sidelines. They are waiting. They are unsure. Some got scared during the correction. Others are hoping for lower prices that may never come. And this hesitation creates a gap between where the market is and where most people think it should be. And when that gap closes, prices usually move fast. We've already seen how quickly gold and silver can rise when momentum builds. And the next move could be even stronger because the foundation is now cleaner and more solid. There is less noise, less speculation, and more real demand building underneath. Also, don't underestimate silver. Silver often lags behind gold in the early stages, but when it starts moving, it can outperform significantly. It has both monetary and industrial demand, which gives it an extra layer of strength. And once momentum picks up, silver tends to move faster and more aggressively. So the question is not whether gold and silver will move. The real question is, will you be positioned before the move happens? Because once the market fully confirms the trend, it usually becomes obvious to everyone. And by that time, the biggest gains are already gone. The early phase, the quiet phase, is where the real opportunity lies. And that's exactly where we are right now. This is not a moment of hype. This is a moment of preparation. Stay patient. Stay focused. Don't get distracted by short-term noise. Understand the bigger picture and make decisions based on that, not on fear or headlines. If you want simple, clear, and powerful breakdowns like this on gold and silver, make sure you stay connected with Gold Silver Scope. This channel is all about helping you understand the market in the easiest way possible so you can make smarter decisions. And remember, this is not about quick profits. This is about understanding a major shift that is happening in the financial system.